While Rob is doing that, I want to welcome everybody to the Rundown with Rob and Rich, which we're doing every other Friday at 3 p.m. Eastern. Very loose, lighthearted look at what's going on in the mortgage industry. And my illustrious co-host working through his technical issues here. And okay, it looks better. There we go. That may not stop people from harassing you in the chat, but they'll just have to find something else to harass you about.
Because Rich, I write my commentary using this computer. I tend to breathe really heavy when I'm doing it. And I guess, over time, the lens gets foggy.
So let's go ahead and get started. And Rob, I heard you're holding on to a ton of GameStop stock. Is any truth to those rumors?
Yeah, in fact, I don't even know why I'm doing this Zoom call, Rich. I should be I don't know where I'd go, actually. Isn't that something? It reminds us that, people are people, and there are fads, and there are, tulip bulb issues or tech stock issues. And even when you think, oh, people are too smart to do certain things, or no one will do that again, or no one will fall for that, or whatever. When you look at that, when you look at Bitcoin, I mean, some of the things that are going on right now are really, interesting case studies in psychology and investment, what people do with their money. It's very, very interesting. No, I don't have any of that.
No.
Do you?
A little.
Okay.
I wish I had more. I'm still hanging on to it. If you see me looking out of the corner of my eye at my phone, I'm nervously tracking the progress as we head towards the market close. So, but yeah, I'm a huge Reddit. I've been a Wall Street Bets lurker. I post rarely for many years. So I wish I would have jumped in more fully, but I'm on the ride here, kind of. So.
I'm pretty simple-minded when it comes to investments, and I hearken back to what my mom would tell me, or what she would say about something like that. People need to eat, and people need to drink clean water, and people need electricity and so forth. So I'm pretty conservative. I tend to put my money into things that I can understand versus things like that, to my detriment. I hope you strike it rich.
Versus, dying strip mall companies that just a group of internet bandits decide to, right? Yeah.
Right.
It's crazy though. It really has been interesting, the whole Main Street versus Wall Street, clash that has come to a head this week. So
yeah, and I think when, in terms of how this might relate to mortgage banking and lending, as we've talked about, the lenders that are out there and the loan officers many of whom had a very good year last year, it reminds us that borrowers need somebody to help them with issues. And whether, I'm not saying loan officers are going to explain, Reddit and GameStop and all that, but the mortgage process is so complex, and it's very helpful to have a loan officer that the borrower can call or email or text, or however they want to communicate. It's that personal touch, I think, that's helped so many millions of borrowers last year and in previous years, and will continue to help them. So the originators being there to help explain, the complex mortgage process, very, very important.
moving on, but before this show a couple of weeks ago, I started a LinkedIn jihad calling for you as the next FHFA commissioner. Since then, hundreds of likes to the post, many thousand views, comments. No, can we take this any further? No.
No, I just hope, we as an industry hope whoever gets appointed or nominated or hired to do certain jobs, those people have common sense, and that they are intelligent, and that they understand both what borrowers are trying to achieve, but also what the industry is trying to achieve. Because if you think about us as an industry, you know, I don't know how many people there are on this call, but if you add up everybody's collective experience, it's probably thousands of years of mortgage lending experience and opinions and thoughts about what works and what doesn't work. And so for anybody in those kind of roles, whether it's director of the FHFA or Fannie Mae, or Freddie Mac, or FHA, those positions are very, very important. It's important for them to understand the industry and that we're not, you know, a bunch of scoundrels. So I'm okay sending out my simple commentary to, you know, a couple hundred people a day and not running the FHFA, but I appreciate the nod.
Yeah, you got a great gig, I got to think. I mean, that would be all kinds of drama, and yeah, I mean,
Oh, yeah. The FHFA, of course, when you talk to somebody from Fannie Mae or Freddie Mac, they can't really talk about their future, but to be running the FHFA and have Congress, you know, sitting on one shoulder and the industry sitting on the other shoulder and the public, you know, out there watching your every move, it would just be, I would think it'd be a nightmare of a job.
and then, you know, we're not back on this show for another couple weeks, so the Super Bowl will have passed. You got a Super Bowl pick? Any dog in that fight? Tom Brady, you know, versus Mahomes? Any dog in that?
I'll root for Kansas City. What about you?
Whoever I bet on, and I haven't decided yet. Yeah, you know, that's I mean, you know, my Cleveland teams, I'm diehard to the bone. And other than that, it's where my money is riding, and that's where my loyalty is. So, which is like GameStop.
That's a very mercenary outlook.
I look at it as capitalistic and opportunistic, right? Yeah. So it's my Cleveland teams. You know, that's where my fandom lies. So everything else, it's, you know, it's opportunity. So, all right, getting into actual mortgage matters, which is supposed to be the bane of this show. So all kinds of stuff going on right now. Biden's getting settled in to office, starting to make appointments. And Federal Reserve came out recently, and, you know, no big shock, but basically reiterated their commitment to bond buying, that we're nowhere near any sort of recovery, reaffirming their commitment to, you know, fixed income. And that obviously affects our industry, as mortgage rates, you know, fueling heavily, obviously, off of that. So any thoughts there? Just, you know, some of the new administration stuff, the Fed, their newly public stance on their commitment to the bond market.
Yeah, well, you touched on so many topics and so many subjects. With the new administration, people were talking about regulations and people were talking about interest rates in the economy. Right now, as we all know, the economy, not only our economy, but the world economy, is being driven by the pandemic. And frankly, until we get that squared away, you know, we're going to be subject to all kinds of things going on. People talk about, you know, what are interest rates going to do, and what is the Fed thinking? And the Fed has pretty much made it clear. The Fed has made it clear for a number of months that they expect rocky times ahead for the U.S. economy, and they expect to keep rates very, very low for quite some time until they see some kind of pickup in the economy. And I think folks on the phone call, you know, as a quick example of the economy, you know, ask yourself, for example, when was the last time you were in a theater? You know, what was the last time you watched a movie in a theater? I don't remember the last time I was in a theater, and yet AMC stock is doing very, very well. For whatever reason, that's a separate discussion. But nonetheless, until the economy picks up some steam, we can expect low rates. And what do I mean by low rates? You know, I'm talking about, you know, if you can get a 30-year fixed rate mortgage for 2.75% or 3% or 3.25%, that's still a very, very low rate. Occasionally, people will ask me, Rich, about 0% interest rates, especially with regard to the Treasury, not so much mortgages, although I think Denmark has some kind of great mortgage. And if you go back to, Japan has had 0% interest rates for quite some time. And if you think, wow, is the Japanese economy booming? It's not booming. It's not really doing much of anything. But yet 0% is still stuck in some people's minds. But once again, you have to think about what let's say, Rich, you could snap your fingers and Treasury rates, the 10-year would go to zero or whatever. The cost of borrowing will go to zero. The issue is that when you're talking about IBM or talking about PepsiCo or talking about whatever, if you offer them 0% financing, what will they do with that money? IBM might say, well, we can't, the demand for our products isn't there. And so, maybe we would open up a new factory, or whatever, but using the 0% money, but there's no demand. So there's no need for us to build a factory. With borrowers right now, if you look at today's personal income and consumption numbers, the savings rate, which used to be just a couple percent, now is up near 14%. It came in at 13.7%, I believe. People who are working are saving their money. They're not flying off to Cancun. They're not buying, $100 neckties or $1,000 watches. They're the people who are working. They're sitting at home. They are not spending a lot of money. There's a whole another segment of the economy that it isn't hard to see. Going back to you look, the maid at the Marriott or the short order cook at the local bar and grill. They are really being negatively impacted by what's going on with the economy and what's going on with the pandemic. So when you talk about interest rates and when you talk about the new administration and the Federal Reserve and so forth, and by the way, I don't know, there's not a lot of linkage now between the Federal Reserve and the new administration because the Federal Reserve is a separate entity. But the Federal Reserve has said, we're going to have low interest rates for quite some time. On the administration side, the things that they are doing to try to control or do away with the pandemic and to try to motivate the economy, those are all going to take months and months and months to achieve. And so we could very well see low interest rates well through 2021, which is good for our industry. It's not great for our economy, but it's good for our industry. And so the refinance volume should continue to be strong for a while. Purchases may pick up, and our business should continue to do well. So that's a good thing for the folks on this call.
Absolutely. And yeah, a lot of comments in the chat about some of the stocks you mentioned, all doing well today, including AMC. But and so you talked about the regulatory piece. I know you've said in the past, that mortgage lenders today are much more compliant in general. It's without a doubt. I mean, I just think, I think our industry, honestly, you talk about what's going on with Wall Street right now and what's happened with the newspaper industry and 25 million other industries where they've been kind of modernized. I've seen that happen in the mortgage industry. I, kind of joke, all the time, the mortgage industry was such the good old boys club. There's a lot of old white guys really for many, many, many years. We've seen some, needed and positive change there. I talked to some of our CEOs of our member companies. They're young, dynamic. They just think different than mortgage lenders have thought in the past. And, I see that. I've seen our industry kind of get modernized, and I think that will continue to happen here really, as tech continues to emerge and, we see the industry continue to really change how we manufacture a loan and how we do business in general. But where I was going with all this in the compliance piece, the CFPB, to me, this is we are about ready to get a cataclysmic change from a regulatory perspective. I'm not saying it's good or bad. I'm just saying we are going from one end of the pendulum to the other, as it relates to the CFPB and Rohit Chopra was very close with Elizabeth Warren. And, like my interpretation of that whole thing is like when all the Democratic candidates that laid down to, clear the runway for Biden ended up being a smart strategy was Warren and Klobuchar and Buttigieg, and Buttigieg just got an appointment, right? So the favors are starting to come now, right? Why do you, when you broker those deals, when everybody laid down and got behind Biden, because at the time that was still a race, but to me, this is Elizabeth Warren's favor. I think the CFPB was her baby, and, very publicly on record of just being nauseated at what it had become under Trump. We talked at the last version of this episode that, some good things have been done at CFPB. They had been much more open, transparent. They've sent people to our conferences that you talked about. But the regulatory change, any thoughts on that and how it's going to impact mortgage lenders these next couple of years? And I'm worried about, I tend to over worry about things, but I think I might be validated here.
Your brow is definitely furrowed. The you and I will disagree a little bit. It'll be interesting to see. I have a slightly different outlook. I wouldn't use the term cataclysmic. When you say cataclysmic, to me that means, holy smokes, there's going to be, dinosaurs roaming the earth here, and there's going to be a meteor striking New York, and blah blah blah. The point that I think that I try to make, the point that I believe in, is that for the industry and for the people on this call, they are doing things differently than they were 10, 12, 15 years ago. We are, and there are always going to be exceptions, sure. But we as an industry like having borrowers have the ability to repay. We, in servicing handoffs, we do a much better job handing off servicing, transferring servicing than we did 10 or 12 years ago. The consumer complaints are way down. And so I liken it to, and I may have mentioned this on the last call, if I'm going down the highway and the speed limit is 65 and I'm going 65 and there's a state trooper driving next to me or by the side of the road, I'm going to say to myself, I'm going the speed limit. My car is registered. I have nothing to be afraid of. I'm not going to get pulled over. Whereas, 10 or 12 years ago, people were going 90 miles an hour, and they had a reason to get pulled over by the trooper. Now, I would say that the vast majority of lenders are doing the right things. They're doing them in a compliant manner. They are paying attention to regulations. They have beefed up their QC departments. They have beefed up their compliance departments or outsourced their compliance departments or some of the compliance work. They may have enlisted the help of some attorneys and so forth. And so the machine, these factories that are producing mortgages, I think, are doing a much better job of producing mortgages than they were some years ago. And they are producing a finished product, which is a very, very good finished product. The investors know what they are buying when they are buying agency loans, for example, or when a company is brokering or selling on a correspondent basis a jumbo loan or a non-QM loan. It's very much, there's no stated income, stated asset kind of stuff going on. And so, yeah, there could be all kinds of changes at the CFPB, but maybe the CFPB will turn its attention elsewhere besides mortgage banking, because frankly, I don't think as an industry we are broken. I think we have thousands of lenders out there that are doing a great job. And so let the CFPB look over at, payday lenders or car loans or student lending or something else. So I'm not, and maybe this is a little bit Pollyannish of me, but I like to think that the lenders now, whether they're using technology that's supplied by vendors who are very aware of compliance and regulatory issues or whether they're doing it themselves, I think we're doing a much better job than we were, like I said, 10 or 12 years ago. So I mean, there might be some changes, there might be some things going on. I like to hope that the CFPB and other state level regulatory entities, because there are plenty of those, continue with education. Because I think the last 4 years, the CFPB has swiveled, to your point, and moved more towards an educational process, moved toward a process where it's taking input from the industries that it touches and incorporates that into its decision making, rather than go back to the Richard Cordray days when it was, shoot first, ask questions later, grab the headlines with a big enforcement action against whoever it is for point banks or RESPA violent, whoever it might be. So I think that there will be changes. I agree with you that there will be changes. I don't know if there will be cataclysmic changes, but like I said, I like to think that we're doing a much better job than we were some years ago. We don't have as much to be afraid of.
I agree. I mean, I think the lenders that are still in the marketplace are much smarter, much more compliant in general. You mentioned technology is a big part of it too. I think technology plays a big part in if it's, detecting fraud or just quality checks on loans, things like that. The technology is kind of taken care of now instead of humans. So from those perspectives, I think, yeah, we're so much more compliant of an industry, and it needed to be that way. My fear more is if you just look at how much mortgage volume was produced this year, and look at who was doing it. Just having been in the banking world for many years and being just so heavily regulated in my years doing that, I look at just the pie of mortgage volume, and now I don't know exactly what the market share. My guess is that 60s is the percentage of non-bank mortgage lending when you look at companies like Rocket and United Wholesale and some of these other big guys that have just been growing, a lot of them going public now. So my fear is that from a compliance perspective, they're going to look at that. Those organizations, non-banks, are regulated much differently and primarily by the CFPB than banks. And that is what's going to catch their attention, that we just have hundreds of billions of dollars of mortgage volume being done by these non-banks that I would agree are generally doing things the right way. And some of these non-banks have very brash CEOs, United Wholesale and Quicken, Quicken had very public spat with the government over FHA loans and, really went out of their way to kind of thumb their nose at the government, through that investigation. So that's what I worry about. And just, collecting all this additional HMDA data, I feel like really from a regulatory perspective, if you're a non-bank, sooner rather than later, you're going to be held to the same fair lending. If you're Rocket Mortgage and, your footprint is in these areas, or pick the non-bank, that you're going to have your feet held to the fire to lend to people, or at least take applications from people that meet and match the demographics of the areas that you have footprint in, that could really cut from a cost perspective. The cost to comply with that kind of stuff can be heavy. So that's more my fear. I don't know if that makes any sense.
Sure, absolutely it does. Compliance isn't cheap. Fair lending isn't cheap. You can quote me on that, Rich. But it is, and there is definitely a school of thought out there that says, gee, I'm a small mortgage company. I can't afford to do some of these things compliance wise or regulatorily wise that the larger companies can do. And so, I'm sure there's some of that going on. However, like I said, the gross discrepancies between rules and regulations back then and what companies were doing was dramatic. That said, the CFPB and other regulatory bodies have further advanced the rules and regulations. They've clarified. I think the last 4 years, CFPB has done a good job in terms of clarifying where their head is in regarding some of these gray areas. And yeah, there's still some gray areas that need to be worked on. But, for example, publishing a frequently asked question website on MSAs, I think has helped a lot of companies say, okay, now this makes sense. We can do this. We can't do that. I hope that the CFPB, as I said earlier, continues to clarify and educate on some of these issues. And I think if that's what they do, I think we'll be in good shape.
Comment in the chat. Agree. The CFPB sees IMBs as cash cows. The fines and penalties will increase regardless of quality or compliance. And that cuts to the heart of my fear. Like, mortgage companies made so much freaking money this year. A lot of these companies are now filing to go public. So it's all out there. Well, it's not going to be
Don't tell anybody.
Because, right, the biggest ones are going public. And I do think, just from an opportunistic standpoint, I think the way that the new CFPB is going to look at mortgage lending is an uncomfortable amount of volume is going to non-banks that are regulated much different. These lenders made so much money last year. On some level, I think, government is uncomfortable with non-banks doing a certain percentage of the mortgage volume. They're going to look at those. If there's an example to be made, while you can also line the pockets of that regulatory body, I think that that's something that you could really see happen. So
yeah, there's some of that's already going on in terms of the loan level price adjustments that exist right now. I remember many years ago, and I meant to look this up, but remember the 10 basis point that came out of the guarantee fee to pay for some kind of tax issue. This was like 10 years ago, 12 years ago. They've never removed that 10 basis points, even though, it's the gift that keeps on giving to the government. If you look at the adverse market fee that the agencies are charging now, it's like, I receive a lot of emails from people saying, what the heck? Where's the adverse market? Property values are going up, loan to values in effect are going down because the values are going up. So there's less risk out there. What are we talking about in terms of the adverse market fee? Why do Fannie Mae and Freddie Mac, the FHFA, still have that? And once it's implemented, as it has been starting December 1, will they ever remove it? Will they ever do away with it? And unfortunately, I have a little bit of a negative viewpoint because I don't think they'll ever do away with it. It'll be called the adverse market fee because something might happen with forbearance. Something might happen with delinquencies and foreclosures. I don't see the forbearance boogeyman really jumping out and grabbing the industry and grabbing the market in the United States in terms of properties and values. But yet the agencies continue to charge this adverse market fee. There is some chatter about the Biden administration doing, having some influence on that to try to help borrowers. There's also talk about the Biden administration exerting some influence on the FHA mortgage insurance premium, potentially reducing that. So, we'll see what happens. I'm going to put on my unsinkable Molly Brown hat here for a minute, Rich, and say that as an industry, I don't think the Biden administration, I don't think the CFPB, I don't think Congress, whoever wants to hurt us as an industry. We've been helping millions of borrowers for, especially in 2020, we were expected to help millions more in 2021. We as an industry have been through so much in the last 10 or 12 years. The CFPB, TRID, now we've got the new application coming out. And we continue as an industry to overcome these, whether you want to call them speed bumps or hurdles or roadblocks or whatever. We as an industry continue to help borrowers. And as long as the regulators and the government keeps that in mind, I think we'll be in good shape. And you're right. I mean, we had a fantastic year. There's nothing really to complain about if you're a lender or a loan officer right now. Things are firing on all cylinders. Rates are low. Pipelines are still full, and we are originating loans in a compliant manner. But you're right. Companies made a lot of money, and those companies that have gone public or are going public, suddenly their earnings are out there for everybody to look at. If you look at Loan Depot filed with the SEC recently, and you can see how much these companies make. And I like to make a joke about politicians. Politicians never want to see anybody out there making more money than they do every year. And frankly, I think a senator earns about $174,000 or $180,000 a year as a U.S. senator, Elizabeth Warren. All right. So I'm sure that she and other politicians and regulators are looking at us as an industry saying, well, that's a golden goose. Yep. That's ripe for the plucking. And let's get a share of that. So yeah, I could see that happening, unfortunately, but let's hope it doesn't get too carried away.
Yeah, definitely some comments in the chat and the Q&A about the adverse market fee, and go about another 5 minutes here with Rob Chrisman on the rundown with Rob and Rich. But a couple of things I want to get back into here a little bit. One is the adverse market fee, and a lot of comments in the chat, just people echoing the belief they don't think it's going to go away. It's a tough spigot to turn off. And I think that the way that, FHFA and the Fed are looking at that too, is they're like, hey, well, so a 10 basis point, 50 basis point adverse market fee, or a 10 basis point increase to G fee. It's like an eighth in rate, at the end of the day. 15 basis points maybe is the net correlation to how it, affects a borrower that's refinancing or buying a new home. And I think part of the way that they're looking at it to justify it is, well, hey, we're buying the living hell out of the long end of the bond market to help manufacture mortgage rates low. We're helping you drive rates down. Thus, we feel less bad about putting 50 bips in our pocket on every transaction. It'll be very interesting to see, one, the industry outcry to erase that fee when things turn. We've talked about this before. Times are great right now. Volume is good. When things turn, I just think we're going to go into this insanely low margin, insanely competitive market with all these lenders that have made money, built war chests, added employees, bought new technology, looking to continue to feed the beast. And I think people are just going to be beating each other over the head for volume like we saw 2 winters ago. So you get into that type of climate, 50 bips on, any type of volume, or a guarantee fee increase that lenders a lot of people don't even realize that they're seeing it in their cash pricing reflected in a lower price. It'll be approach that.
There's some, if there's any good news in that, and I agree 100% with you, but if there's anything good to think about, or one way to think about it, is that it impacts everyone in this industry, whether it's Rich's and Rob's, mortgage, or Wells Fargo and Rocket. That fee isn't selective. In the old days, there would be company specific fees, there would be company specific G fees, guarantee fees, guarantor fees, and so there was a feeling that the playing field wasn't level. Now, at least, misery loves company to some extent. The whole industry is impacted by it. It's not like Rich and Rob have to pay a 50 basis point guarantee fee, and some company like the mortgage firm in the Southeast only has to pay 20 basis point adverse market fee. It's uniform at least. So
last thing I want
hopefully they do away with that. Oh, go ahead. Sorry.
Last thing I want to touch on, you mentioned, marketing services agreements. It's a huge topic for our industry, just because a big part of our industry is, getting referred business from realtors, builders, financial planners. And it was great to see the CFPB come out with that, FAQ. It was like, I don't know, like 4 or 5 months ago, where they almost kind of said like, hey, marketing services agreements under these, tenants are legal, which we've always believed to be true. That said, that's not how the previous version of the CFPB viewed it. I mean, I think I talked about it, I forget if it was this show or another, but the bank I was at before I took this job 6 years ago, I spent 6 months, my last 6 months at that bank, unwinding all of our marketing services agreements because of how that CFPB viewed them. And we just viewed it institutionally as way too much risk to be in all these MSAs with all these real estate brokerages. That's another thing that it's going to be very interesting to see how the CFPB handles that, specifically related to our industry. Guidance on marketing services agreements, RESPA. It's a very gray area, like the whole, you can't pay for referrals, but you can pay for marketing services. And that's another one of my worries as we move forward here.
Yeah, I think, of course, they can't, they can't, once again, using my analogy of going down the highway and I'm going 65, and then next month they change the speed limit to 60, they can't come back to me and say, well, you went 65, so we're going to penalize you, because I'm going to say, well, that was the speed limit then. If the CFPB does change things, or the state regulatory institutions, and there are a lot of state regulatory institutions that are out there, but if they change the rules and regulations with regard to MSAs, for example, they can't go back and say, well, you were doing it this way in 2020 or 2019, and now we've changed to that, and that makes that illegal, so we're going to penalize you. As long as they educate us and tell us, I think that's, half the battle.
Question, and if anybody has any questions or comments for Rob or I, this would be the time to do it as we look to get wrapped up here. Had a question come in, Rob, for you. Where do you guys think, I'm just saying this one's for you, the agency desk caps at 1.5 billion possibly may land in reality, and how that will impact independence?
So, good question. For the most part, the agreement that the Treasury reached with the FHFA a couple of weeks ago was greeted by the industry very favorably. I think they incorporated many of the things that we wanted, but that was kind of one sticking point. It's like, oh, you're going to cap the amount that I can sell to a window at $1.5 billion for 4 quarters. Well, if you look at it, it's $1.5 billion per agency. So you sell it to the Fannie window, sell it to the Freddie window, that's $3 billion. That tends to impact the aggregators like PennyMac or AmeriHome, and some very large companies like Fairway Independent, Rocket. We have a year, okay, so this doesn't take effect for another year. So we've got a little time, all right? The question has been, well, traditionally they have pushed us toward the window and away from issuing our own mortgage-backed securities, and now they are putting a cap on the amount that we can sell to the window. You are, in effect, potentially handcuffing our execution capabilities for our capital markets team. If they can't sell to the window when they hit a certain cap, then they have to sell to an aggregator, or maybe that aggregator's hands are tied because they've capped out, and then you end up going into the mortgage-backed security route. I think that as I said earlier, we have a year to figure this out. We have a year to try to influence and change that, perhaps with a different person in there than Mark Calabria. If that comes to pass, I think we've got some time here to play with that. So I'm not as worried about that as as some of the other things that they might have done. So hopefully they change the language, and even if they don't, I think it'll impact a relatively small number of players. And we still have mortgage-backed security, MBS execution out there to utilize. So it's not curtains on the industry. It's just it's a different it's a different way of potentially executing as you near that cap.
Excellent. Well, thanks for the questions, everybody. Thanks for the feedback, and thanks for joining us, Rob. Always enjoy the conversation. This was great this week, though. A lot of good topics, a lot of stuff to keep our eye on as we move forward here, and appreciate you joining me.
Yeah, I wanted to wear a Hawaiian shirt. We're in the dead of winter. We're approaching the Super Bowl. I wanted to liven things up a little bit with a Hawaiian shirt. Yeah, it's hard to believe we're almost done with January already. Where'd the month go? So, Rich, thank you very much for having me.
Absolutely. And thanks again to everybody for joining us. And we'll be back 2 weeks from today. I think that's Friday, February 9th, if I remember correctly, 3 p.m. Eastern for the Rundown with Rob and Rich. Until then, have a great weekend, everyone. Take care.
You too, Rich.
Bye, Rob.